Welcome to our channel. Today, we're diving deep into the world of venture capital investing. If you've ever wondered how some investors manage to back the next big tech company or the next revolutionary startup, you're in the right place. In this video, we'll be covering everything from what venture capital is, how it works, and most importantly, how you can spot and invest in the next big thing. First things first, let's talk about what venture capital, or VC, actually is. Simply put, venture capital is a form of private equity where investors provide funding to startups or early stage companies with high growth potential. These companies typically lack the operating history to secure traditional bank loans, but they often have groundbreaking ideas or innovative technology that investors believe will be profitable in the long run. The main goal of a venture capitalist is to provide early funding in exchange for equity, meaning they own a part of the company. The hope is that the startup will grow, scale, and eventually provide a huge return on the investment, either through an acquisition, an IPO, or some other form of exit. Now that we understand what venture capital is, let's break down the stages of venture capital investing. Seed stage. At the seed stage, venture capital is used to help startups with very early product development. Often, these companies are still in the idea phase and need funds to get off the ground. Early stage. In the early stage, companies have typically launched a product and may have some initial traction but need more funding to grow their business, expand their team, or scale production. Growth stage. The growth stage involves companies that are already generating revenue and are looking to expand aggressively, either through marketing, new product lines, or entering new markets. Venture capitalists will assess the risks and opportunities at each stage, deciding whether to invest based on the company's potential for success and the current market conditions. Not every startup is destined to be the next Uber or Airbnb, so what makes a venture capital investment a good one? Innovative idea. First and foremost, the startup needs to have an innovative idea or product. Something that solves a real problem in a unique way. Scalability. Next, scalability is key. Investors want to know that the business model can grow quickly and efficiently. Think about how tech companies can multiply their customer base without having to significantly increase costs. Experienced founders. The experience and passion of the founding team are often as important as the idea itself. A strong team that understands the market and knows how to execute is a critical component of any successful startup. Market size. Investors also consider the size of the potential market. If the startup is targeting a massive industry, the upside for growth is much larger. While the rewards can be huge, venture capital investing is not without its risks. High failure rate. Startups are notoriously risky, with many failing within their first few years. Even if a company has a brilliant idea, poor execution or unexpected market shifts can lead to failure. Illiquidity. Unlike publicly traded stocks, venture capital investments are highly illiquid, meaning you can't easily sell your stake. You might have to wait years for a return, if any. Dilution of ownership. As startups grow, they often need additional rounds of funding. With each new round, your ownership may be diluted if you don't continue to invest. These risks underscore the importance of doing your due diligence and thoroughly researching any company before making an investment. Now, the big question: how can you spot the next big thing? Industry trends. One way to identify promising startups is by staying on top of industry trends. Pay attention to emerging markets like artificial intelligence, renewable energy, and fintech. These are areas where we often see explosive growth. Unique value proposition, UVP. Does the startup have something that sets it apart? A strong UVP indicates that the company can offer something better or different from its competitors. Customer traction. Look for early signs of customer traction. If a company is already gaining users or customers before major investments, it's a good sign that the product or service is resonating. Founders with grit. Lastly, look at the founders themselves. Those with grit, perseverance, and the ability to pivot when things go wrong are more likely to lead successful startups. It takes a combination of research, timing, and sometimes a bit of luck to invest in the next billion-dollar company, but by following these guidelines, you'll improve your odds significantly. So, how do you get started with venture capital investing? Network. Building a strong network is crucial. Attend startup events, join angel investing groups, or connect with other venture capitalists. You'll often find the best opportunities through word of mouth. Online platforms. In today's digital age, there are platforms like AngelList and Seed Invest that allow you to start investing in startups with relatively small amounts of capital. These platforms make venture capital accessible to more people than ever before. Consult an advisor. If you're unsure where to begin, consulting with a financial advisor who specializes in venture capital can help you navigate the complexities of this space. And there you have it. Venture capital investing can be an exciting and potentially rewarding way to grow your wealth while supporting innovative startups. But as with any investment, it's important to do your research, understand the risks, and invest wisely. If you found this video useful, please don't forget to hit like, comment, and subscribe. Also, click that notification bell so you won't miss any more of our videos. Thanks for watching, and we'll see you in the next one.